Hey, welcome! Today, we are digging into a financial strategy that's not just a few decades old, it has survived for nearly 2,000 years. Yep, it's a timeless rule for building wealth, and it comes from a place you'd probably never expect. Let's dive in.
Look, this is the question, right? It's the one we all ask ourselves. We want our money to grow, of course we do, but we are also terrified of losing it. So you're stuck. Do you go for those high-risk, high-reward stocks? Or do you play it super safe with a savings account that barely keeps up with inflation? It's this constant tug of war, and it can lead to total analysis paralysis, where you just end up doing nothing. But what if the clearest, most balanced path forward wasn't cooked up by some Wall Street analyst last week, but by ancient scholars thousands of years ago? What if a simple, really elegant solution has been waiting for us this whole time, kind of hidden in plain sight?
So that's exactly what we're going to explore. We're about to break down a time-tested rule for managing your money that is, you're going to see, just as relevant today as it was way back then. This whole strategy comes from the Talmud, a central text of Jewish law and wisdom. It lays out this simple but honestly profound technique for dividing up your assets. And I want you to notice the two key goals here. It's not just about prosperity, and it's not just about security. The entire system is built to do both at the same time.
So what is this technique actually? Well, it's so elegantly simple, it's often just called the rule of thirds. Let's break down exactly how it works. The core idea here is just beautifully simple. You take your total capital, everything you have, and you divide it into 3 equal portions. That's it. 1/3 goes into what the text calls merchandise, another third goes into property, and that last third, you keep it as cash. Each of these pieces has a very specific job to do. And the process itself is incredibly straightforward. First, you figure out your total capital. Second, you allocate it into those 3 equal baskets we just talked about. And third, and this is the really important part, you work to maintain that balance over time. It's not a set it and forget it thing, it's a dynamic strategy. But why these 3 categories? I mean, why not 4 or 2? Well, each one was chosen to fill a critical role in your financial life. Together, they build this complete financial picture that really covers all your bases. So that first third, merchandise, this is your engine for growth. This is the part of your portfolio that's out there actively working to generate profits and build more wealth. You can think of it as your business ventures, the assets that have the highest potential for prosperity. Okay, this second third, property, is your foundation. This is your bedrock. It represents tangible, stable assets. It's meant to provide security, to protect your capital from things like inflation, and to just offer that long-term stability. Honestly, this is the part of the portfolio that helps you sleep at night. And that final third, the cash, well, that's all about readiness. This is your liquid capital, and you keep it on hand for 2 big reasons. First, to handle any unexpected emergencies without having to sell your other stuff. And second, and this is crucial, to seize opportunities. When that perfect investment or a great deal comes along, you are ready to pounce. Okay, so merchandise and property. I know, it sounds a little ancient. How does this 2,000-year-old advice actually work in our modern financial world of stocks and bonds and everything else? Let's do a little translation. I mean, this is the key question, isn't it? We're not exactly trading silks and spices on the Silk Road anymore. So what are the modern equivalents for each of these 3 buckets? So here's how you can think about it today. Merchandise, your growth engine. That translates pretty directly to things like stocks or mutual funds. Property can be actual physical real estate, or maybe more accessible for most of us, something like real estate investment trusts, REITs, which are basically companies that own income-producing real estate. And cash, well, that's your liquid stuff, a high-yield savings account, short-term bonds, or maybe a money market fund. So why is this framework so powerful even today? Because it forces you to be balanced. It has built-in diversification. You're automatically spread across different kinds of assets. It naturally balances that hunger for big returns with the absolute need for security. It makes sure you always have liquidity, cash on hand, which is something a lot of modern strategies can kind of forget about. And maybe best of all, it's a simple, timeless framework you can actually use without needing a PhD in finance. And here's the original advice translated: 1/3 in land, that's your property. 1/3 in business, that's your merchandise, your stocks. And 1/3 in hand, that is your cash, ready for anything. It's just as clear and powerful today as it was 2,000 years ago. So you see, this is more than just a strict investment formula. It's really a philosophy. It's a mindset about creating financial well-being through balance, balancing growth with stability,
risk with safety, and ambition with patience. It's about building a financial life that can take a punch, but is also ready to grab an opportunity.
And that really brings us to the final thought I want to leave you with. Take a second and look at your own finances through this ancient lens. Are you maybe too heavily weighted in one area? Are you actually prepared for both a market downturn and a sudden opportunity? Is your wealth balanced? It's a really powerful question to ask yourself.